Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. We had a big takedown in the markets here Thursday and Friday. Really a classic raid and takedown in the aftermath of Wednesday's FOMC meeting, where they announced they would completely stop QE by the end of the month. And in classic fashion over the last few years, the takedown began with that FOMC announcement, was that 2 p.m. Wednesday, continued into Thursday, and got brutal in the overnight hours, early Friday morning in the London session and the early COMEX session. We had silver trade down to, I think the intermittent low here on Friday morning was right around 1560 or 1561. And then the other big story from a technical perspective is gold breached below the triple bottom at 1180. First set as a bottom last June of 2013, and had held the last two tests of that level. And gold was not only plunged under 1200, but broke that level to the downside, traded as low as 1160 today. Obviously, the cartel knows technical analysis, and they like nothing better than to paint the charts. And what they're attempting to paint here is technical analysts here will look at the gold chart breaking that triple bottom and look for gold to head down to test 1,000 here. Whether that happens or not, we'll get into a bit later in the show. And then on silver side, that 16 level really holds as the bottom of the entire uptrend from that level up to the $50, so that entire second stage of the bull move. In really breaking below 16, and the next support level down really isn't found until somewhere around the $8 and $9 range. So it really was a brutal couple of days, Eric, and it's been a tough one to swallow for a lot of investors. But again, it does present opportunities to acquire at the best prices that have been around in a few years now.
Not much consolation for anyone who's holding long, obviously, but it is best to buy when there's blood running in the streets, and blood is pouring right now. I was looking over the volume numbers for things like GDX and number of contracts traded in the COMEX pit for gold and silver, and key stocks in the silver space, like say First Majestic, or you can actually look at pretty much any other name. I'm not specifically zeroing in on any particular equity per se, but what's interesting is that we're looking at today's volume as being, generally speaking, on most of these instruments, most of these contracts and shares and whatnot, as being the largest down volume for the entire year. It's not a blow-off kind of thing. It's not, 3 times normal volume that you'd expect, but nonetheless, it's still indicative of at least a partial capitulation. And in the aftermarket hours, some of the equities, in fact, were catching a little bit of a bid and a little bit of a bounce back. A lot of the selling, particularly in the equity space, was margin selling driven. And frankly, I think we're going to bounce next week. So when it comes to the question of silver at that $16 level you just spoke of, we'll probably hold it. I mean, the thing is, though, is that there's a number of issues on the horizon that the powers that be are kind of freaking out about. We spoke earlier today with Egon von Greyerz, and that interview will be broadcast next week. And in looking in more depth at this Swiss gold referendum, that has a pretty decent prospect of passing, and the ramifications of that are certainly of great concern to the cartel, because if the Swiss central bank has to move up to a 20% coverage of their assets in gold, that would be a pretty monumental amount of gold purchasing that's simply not available, even though they're talking about a 5-year buying period for that. But anyway, that said, it looks like the markets are to some extent seeing some forms of capitulation. And what's really interesting, too, is that it seems like this whole QE cycle is having less and less impact in terms of bang for the buck, or bang for the yen, if you will, or the euro, as the various central banks take their turns rotating as to who's going to do the majority of the QE expansion. And right now, Japan is in the driver's seat, and they just announced this expansion of QE to an additional from 70 trillion or so yen per month. Now they're going to do 80 trillion, and you normally would expect that kind of an announcement to raise all assets, but other than gold and silver, of course, because gold and silver get attacked by the cartel. But interestingly enough, oil actually was down today in the wake of that news, which is quite unusual. I mean, it's kind of showing one data point that suggests that there's still this ongoing war between those who believe that the economic backdrop in terms of real economic activity versus the financialization, paper pushing, asset venue of choice where the powers that be permit the expression of monetary inflation, being the equity market first and foremost, real estate secondarily. We still see that having an impact to the upside, and the stock market is doing well in response to QE, but it's not universal anymore. Back in the day when QE1 was announced in the United States, all assets moved up. Now, Japan announces an expansion that's perceived as a surprise, and you have oil fall. I mean, that tells, that paints a partial picture of what's going on here, and I think that to a large extent, it's an expression of the age of this bull market run that's been driven by monetization of debt and the QE process, and it's getting long in the tooth. You have a number of factors that will probably be significant positives for short-term economic perceptions in particular, and to some extent even real economic activity in the United States when it comes to the fact that the price of oil has died so much that consumers are going to feel a little bit more confident and flush going into the holiday season. The Republicans are probably going to take the Senate, and there's probably going to be a general perception in the business community, for right or wrong, however one chooses to look at that, but the fact is that the perception will still be there, that will be a positive for the stock market. And I suspect we're actually setting up to see yet another 1,000 points on the Dow added between now and the end of the year. And I know that is going to surprise a lot of people out there because, all the while we constantly note about how hollow the economy is, how it's being hollowed out, and that the real economy is not really doing very well, even though elements of the real economy that benefit from the financialization process and this paper-pushing mania that is resulting in our financial markets, it does spill over to some extent, but not in totality. And you can see that in the labor force participation numbers. You can see it in the type of jobs that are being created in the United States, where it's a huge emphasis on the service sector. And the last monthly report had the 16 to 19-year-old grouping, as well as the 50, 60 some odd people in age also seeing job increases, but the core of the economy seeing job losses. So I'm on an epic rant here, and basically I think we're setting up to see the final gasp of this QE fiesta. It'll probably extend through to maybe sometime mid-January or so, but at that point we already saw how Fed Governor Bullard, the governor in St. Louis, came out a couple of weeks back and rescued the market, basically signaling that QE might not be ended and that the interest rates would be lower for a longer period of time than what market expectations were, and then the dogpiling on of subsequent statements from the open mouthing committee at the Federal Reserve and whatnot. So, all of this combined results in a picture, I think, that paints a picture of a market blow-off. And at some point, gold and silver will respond favorably because if financial assets go down, in terms of stocks and real estate and so forth, some of that money will slosh back into gold and silver, and I think that's what we'll probably see with a really strong first quarter next year, and some stability coming here in this quarter as we move through towards the end of the year in December. But we will probably see one more push down. It's not going to happen Tuesday, Wednesday or so, Monday, Tuesday, Wednesday this coming week, but beyond that, who the heck knows? It's impossible to call because the cartel basically acts on a whim, and it's more of a factor of trying to imagine what the powers that be are thinking rather than what market forces and economics would make somebody conclude as the most highest probability for directions of any given market.
Yeah, I definitely agree with those sentiments, Eric, that blood certainly is running in the streets. I know most of our listeners are likely wondering, especially for the immediate future on Sunday night. I guess somewhat encouraging. Gold and silver were not plunging into the lows in the access market close of the session. We didn't really see a strong bounce at all, or any type of major short covering. Gold really only recovered about $10 off its lows. Silver about 40 or 60 cents, but still gold closing under that 1180, which had been the previous triple bottom support, is not very encouraging short term. In silver, I guess in the access market it did slightly pop back above 16. Definitely still a bit of a concern short term, but I agree with you that we are very oversold, and the physical numbers are pretty astounding. The market in general has massively tightened up over the past week, but particularly the second half of the week, beginning on Wednesday. Just from our perspective with SD Bullion, we saw probably about 10 to 15 times the order volume, both in ounces and orders, over the second half of the week, as we've seen really over the last 6 months, outside of that first day silver broke under 17. We have the U.S. Mint has sold the most Silver Eagles now in a month since the all-time sales record last January of 2013. It was just above 6 million, and depending on whether they add Friday's sales or not to October or November, we were chatting before the show. They often like to, rather than set new records, skew the numbers by adding them to the next month. But October right now is coming in at 5.8 million ounces of Silver Eagle sales. The Canadian Mint is already allocating product. Prices are jumping quite a bit on silver maples. All of the private mints across the country, generic rounds and bars, all the Sunshine products. If you place an order with the Sunshine Mint now, they're about 6 weeks out. And you're seeing that across the spectrum from most of the private mints here in the U.S. Premiums are rising. They've probably only risen on generic products maybe between 10 and 20%, so they haven't doubled or anything yet. But if the futures prices fall any further, you'll see quite rapidly premiums start to spike because all supply is drained off the market. And I also expect Silver Eagle premiums to start moving quite a bit more fairly quickly if the demand continues. And I'm basing that on the fact that the U.S. Mint is coming right up now on 2013 sales numbers, which are an all-time high. And to their credit, it took them a few years, but this year they've been able to meet that demand without allocating metal for most of the year. But really, if we go much more at all beyond the previous sales record for a year, and based on the type of sales we've had over the last week or two, you're going to start to see the U.S. Mint allocate Silver Eagles again, which will send premiums much higher, like we saw in the 2013 takedown. So a lot of that will depend on what the spot price does from here, whether we do have a big short squeeze and a short covering rally, or a further liquidation plunge down the mine shaft, if you will.
Yeah. Another thing, too, that's really interesting is that we actually saw a rise in the open interest for silver today, which is astounding. I mean, gold went down, as you would expect. You can get the numbers here. Gold was down 1,196 contracts today, but silver rose 3,164 contracts. And that goes to show that, these stubborn longs that are taking some significant positions on the COMEX are still there, and they were buying into this dip. It's just unusual behavior to see something like this. I mean, Harvey Organ was speculating that it's largely China behind this action, and that at some point they're going to stand for delivery and use it as a weapon, or at least potentially hold it over the United States' head as a weapon. I tend to downplay the probability of that simply because it's really easy for the exchange to, in a matter of minutes, cash settle everything and close shop for a period of time. So it's really hard to have a financial weapon that can be neutralized that easily. But that being said, there definitely are a mix of interests here that are taking this long side, and they're not giving up. It's fascinating to watch this kind of thing. And the probability of that often spoken of market signal failure, where the COMEX is just unable to deal with the number of people standing for delivery in the December month in particular, is probably setting up here. And at any time in this bull market, we've seen scenarios where that could have happened, but at this point it looks like it's more probable than not. And what I conclude from that is not that COMEX will actually default. What I conclude from that is that the powers that be are aware of this, and that they're going to try to navigate away from, barbecuing their principal tool of manipulation. I mean, if the COMEX basically defaulted, it would be a major blow to their ability to use the COMEX paper market game to manage prices. That's just another factor that fits into this overall picture that suggests that to see prices much further lower would increase the strains and the pressure that are manifesting on the COMEX, particularly in the silver market. So, high volumes of capitulation type selling, not full capitulation, but nonetheless significant. The aftermarket now showing that people are coming in and buying this dip even as we speak. The situation on the COMEX with silver and the various vaults around the world as well being very much depleted, yet Asia, generally speaking, is continuing to accumulate. All these things point towards the reality that if the cartel wants to be gutsy and continue to push markets further down, it's going to cost them a lot. It takes physical metal delivery to keep the system running, even though paper pushing is 100, maybe 200 or 300 times the volume in terms of physical on these exchanges. But they cannot manipulate 100% in the paper world. They have to be able to make deliveries to buyers who have the money to spend and the willingness to stand. And China and Russia and all the other central banks that happen to be accumulating metals have that impact on the market. So, I find it hard to imagine that the powers that be are going to be able to keep things down as they are now for an extended period of time. And so, if we see one more period where, hey, maybe silver will go down to 14, maybe gold will test 1100 and bounce there. That's where I suspect would be the downside. But from a $1 down to $10 upside kind of scenario, I think that thesis still is valid, and the risk reward is phenomenal, particularly for people who are looking at this market in the context of just holding insurance against the lunacy of paper printing gone mad worldwide. If you're able to hold a position of whatever percentage of your net worth in precious metals and sleep at night, that's really the best way to look at how to invest in this market, because the volatility is so wicked that it pushes out people who do any kind of speculation beyond their means of dealing with margin calls and taking on levels of exposure that just freak them out. This is a long-term game at this point. That's the only way long-term investors will be able to stomach the volatility and prevail.
And speaking of wicked, the one other observation that I made, and we were kind of chatting with before the show, is this is about the third or fourth year in a row that gold and silver have suffered a massive beatdown on Halloween. We first saw it in MF Global was shut down on October 31st. Was that 2011, I believe? And gold and silver were taken to the woodshed, and it's been one or two more occurrences since then. And we were kind of laughing before the show. It is, I believe, one of the Illuminati's high holy days, one of their highest holy days, if not the highest holy day of the year. And obviously, it could be somewhat anecdotal, but it's interesting that year after year, gold and silver are smashed on this date. So maybe take that as a grain of salt, and maybe we did see the bottom today here on the 31st.
Yeah, well, also fitting those patterns as well, we would have the late October kind of downdraft, and then you get a slight bounce, and then the tax loss selling comes in, particularly with the equities. So, it's probably going to be a painful month or two or so, but, in the grand scheme of things, 6 months from now, I think that we're going to be back over $20 in silver, and that is going to surprise people.
All right, so we'll keep our eyes, Eric, on the market Sunday night. Hopefully we'll keep our fingers crossed that the pain is over, again, with, unfortunately, gold closing under the previous bottom support at 1180, and silver dipping under 16 to a 15 handle today, placing new lows of what they're about 5 or 6 year lows now for silver. So keep an eye on the market Sunday night, and we'll keep our fingers crossed for a short squeeze rather than continue pain to the downside and any possible capitulation. Hopefully we won't see anything like the technical analysis are going to point towards of the next support for silver at $9 and gold at 1,000, which would really retrace its entire move off of that $1,000 level. That, what was it, about the fourth or fifth tap on the 1,000 before it finally broke above it.
Yeah.
And really, we're looking at potential here to retrace that entire move from 1,000 to 1915, made a couple of years ago.
Yeah, and when it comes to silver at $9, $10 kind of thing, I mean, the cost of production for most pure play silver miners are in $20 and change level, $22 in that bracket, give or take. And to imagine silver being half of what the cost of pulling it out of the ground, it's an untenable situation. And the same can be said for the gold producers as well. I mean, we're looking at something like probably 20-30% of production that will go offline in the next year or two if these kind of prices remain. So, one can pretty easily make the argument that what with continued strong demand for gold and silver in turn, and declining supplies, that these prices at one point will force a break in the cartel's ability to maintain lower prices. They'll do the managed retreat, as we have described before, and we'll get back up to mid-20s in silver at some point, maybe in a year or whatever.
And to that point, First Majestic, obviously it's not the entire market, but even at $17 silver, they're withdrawing a third of their production. So yeah, you can imagine what would happen at $9 silver.
Yeah, and that is something they can do by choice because they're cash positive and they have very low costs of production. But they're a rare bird compared to most other producers, and even the base metal companies that have silver as a byproduct of their production, which happens to actually be the lion's share of where silver comes from, they're hurting, and they're looking at curtailing production of their operations, even copper mines and iron ore and so forth. So the greatest correction to a bear market is, in fact, bear market prices, as Rick Rule often speaks of, and that's exactly what we're seeing here. So the lunacy that we see with QE and how it's driving asset bubbles and how the powers that be really just don't care anymore. They're just throwing caution to the wind, and they're just being very aggressive in the way they pump up financial assets across the board, is analogous to the degree to which they really just don't care anymore about how far they're willing to go to suppress precious metals prices. I mean, it's getting to the point where the sheer lunacy of their activities are creating what will be a monster bull market in the future that they will not be able to stop because the physical supplies will just not be on the marketplace on an ongoing basis. I mean, China, all by herself right now, is already consuming what probably is the entire global output of gold. And if gold were to decline by 20-30% production in the next 2 years, where's that going to lead? China, I mean, and so forth. So these are definitely interesting times.
All right, we'll wrap the show there. So once again, for the Doc and Eric Dubin, thanks for tuning in to the SD Weekly Metals and Markets.
Those individuals who are in charge of monetary policy around the world, I think they're very much aware of what is coming. When I've asked Federal Reserve Chairman in the committee about this, they never said, no, that's not going to happen. They used the word orderly. As long as it's orderly, it seems to be okay.